Greetings, and welcome to the High Flying Tutors Academy channel. Today, we will be helping you on how to prepare or to deal with the topic on asset disposal. We are going to prepare the asset disposal. We are going to prepare the asset account. We are going to prepare the accumulated depreciation account, and we are going to prepare the depreciation account. So let's see what is happening here. Because the first thing we must do is to go through the information provided, right? And then we can be able to see what is it that we are going to do. So this is our question. This is our answer sheet. This is the sheet for calculations, right? So that's the way we are going to work today. So get ready. We are about to start. This is our answer sheet. We are sorted. We've got vehicles, we've got depreciation, accumulated depreciation, and asset disposal. That's what we'll be helping you with today. All right. So let's just go straight to the question and start with the work. Number one, we go through the question. LA traders. The following transactions occurred in the books of LA traders during the period 1 March 2005 to 28 February 2006. The financial year end is 28 February each year, right? And then it says it is the policy of the business to depreciate vehicles at 20% per year according to the straight line method. So according to straight line method, meaning we are going to use the straight line method to calculate the depreciation amount, right? And then on the 1st of March 2005, the beginning of the financial year, the following balances appeared in the books of LA traders. Vehicles at 248,000, accumulated depreciation on vehicles on the 8,167, right? And then additional information or transactions that took place during the year. On the 30th of May 2005, sold a vehicle which was originally purchased on the 1st of September 2002 for 85,000 on credit to MA for 68,000. On the 1st of August 2005, a new vehicle was purchased for cash from Trustee Motors for 105,000. The following cost also incurred: installation of an aircon system, installation of central locking system. So I'm just browsing through the question because we're still going to go through these questions as we calculate certain things and as we record in our answer sheet. So if I'm too quick here, I'm still going to be slow. Don't worry. And then record the above mentioned transactions in the following ledger accounts for the period 1 March 2005 to 28 February 2006. All calculations to be nearest rent, meaning we don't have cents. There's no we can have 2,550 cents or something like that. So we are going to record all our monies in rents. We are going to round off to rents. We don't have cents. All right, that's what it means. And then you are required to prepare the vehicles account. You are required to prepare the accumulated depreciation on vehicles account, depreciation on vehicles, and asset disposal account. All right. So now, number one, we are given a period. Our period, I'm going to outline this period properly because that's the first thing you must do. You need to outline the period first that you are operating in, number one. So let's go to our working sheet or our calculations and say financial period. Financial period. So our financial period, remember, it started, or let me say, usually I love to start with the end, to say it ended on the 28th of February 2006, and then When did we start? We started on the 1st of March 2000 or 2005. 2005. All right. So this is our financial period, and this is 12 months. So we are operating within this period. All right. That's number one that you must do when you are preparing asset disposal or dealing with asset disposal question, right? That's number one. Number two, we are going to go back to our information, right? If you check on the information that say on the 1st of March 2005, the beginning of the financial year, the following balances appeared in the books of LA traders. So at the beginning of the year, we had vehicles worth 248,000. So I want us to go and prepare a vehicle account quickly because it's the simplest one to prepare. So now this date is going to be 1 March, right? Then we're gonna say we have balance brought down, which means opening balance. Balance is at the beginning, right, of 248,000. All right, and then that is number one. Number two, as we proceed with our question transactions, right, they say to us 30 May 2005, which is during the year, we sold a vehicle which was originally purchased on the 1st of September 2005 for 85,000 on credit to MA for 68,000. So the cost price of the vehicle that we sold or disposed is 85,000 initially, 85,000. So it means we need to go to our vehicles account. We have to go to our vehicles account and indicate 30 May on the date 30 May 30 May, we had asset disposal. We had asset disposal. Asset disposal of, so folio there, you can just put general journal. Asset disposal of 85,000. That is our asset disposal. There's a decrease in asset disposal. There's a decrease in vehicle, right? And then we are done with that one. Let's proceed. We are just dealing with transaction by transaction. Very easy thing to deal with because we are still going to deal with serious stuff when we get to calculations of depreciation. All right. And then now they say to you on the 1st of August, on the 1st of August 2005, a new vehicle was purchased for cash from Trusty Motors for 105,000. The following cost incurred: installation of an aircon system 2,280, installation of a central locking system 3,420. So remember, since we purchased vehicles and then there was certain things to be installed, so the total cost of the vehicle is going to be all this, including the purchase amount of 105,000. So we need to calculate what the total amount of a new vehicle or a total cost, right? So I'm gonna come here because now we are doing calculations and workings. I'm gonna say our total cost of new vehicle. It's equal to the cost price of purchasing the vehicle, 1, right? And then plus the cost of installing an air conditioner, which is gonna be 2,280. We add 2,280, right? And then plus we add installation of central locking system, 3,420, right? We're getting the cost of the new vehicle, 3,420. So let's put that on our calculator there. How much is our total cost of the vehicle, including the cost of the installation? So let's do that in our calculations quickly. So it's going to be 105,000 plus plus 2,280 plus 3,420, which is close to 110,700. So this is the total cost of the new vehicle that was purchased, right? And this will go to add our vehicle. So when we add a vehicle, this happened on the 1st of August or August. So we're gonna say bank because we purchased this for cash, and then total amount 110,700. All right, and then we purchase, obviously when we purchase, our folio will be what? General cash payment journal, right? You can just say cash payment journal. Most of you, these things you don't record them off folio, I know, but I just thought that I should, you know, help you with that, because some of you don't even know what is this folio thing. All right, so now we check with our additional information, or our information, if we've got any additional asset that was disposed. No, we only ended at purchasing our vehicle, our new vehicle, on the 1st of August. Therefore, we can close our vehicle account. We can close our vehicle account. So to close our vehicle account, we're just gonna check which side is bigger. So by the look of things, the bigger side is the debit side, right? The bigger side is the debit side. So we're gonna add the debit side and balance with it. So it's going to be 248,000 plus 110,700. I'm getting a total amount of 358,700, right? And then even on the credit side, we're gonna balance or total with 358,700, and then we have to calculate our balance carried down, balance carried down, which is our closing balance. Balance carried down, right? Balance carried down, which is our closing balance. So our closing balance is going to be 358,700 minus or less 85,000 of the asset disposal, and then we are left with 273,700 vehicles. 273,700 vehicles at the end of the year, right? Because this is the closing balance, right? So since this one is the closing balance, we also have to indicate it that next year on the 1st of March, when we open our next period, in the next period, we are going to open with this closing as balance. We indicate right there. We indicate it right here as balance brought down of 273,700. All right, so this is the first account you must start with. Whether we're preparing a asset disposal for machinery or whatsoever, start with this account. It is very easy to prepare, very understandable, where we just indicate whether there's a decrease in asset or increase in asset, or increase in that particular asset that we'll be dealing with at that moment. Now we are dealing with vehicle, so let's proceed. So now we have to go and prepare what? Our accumulated depreciation account on our vehicles, right? So we need to go and check our information. Let's go there. Our information. So now here we have got an opening balance of accumulated depreciation of 80,167. So let's go to our answer sheet. we're going to say on the credit side, because this one opening balance must be on the credit side. Balance brought down, because remember, our accumulated depreciation account is an account that decreases your asset. So it will increase where asset decreases and decrease where asset increases. So now this is where it increases on the credit side, right? So we are going to put that amount to 8167, all right, which is the opening balance on the 1st of March. The 1st of March, right? Then we also have to calculate depreciations. We cannot record anything else until we have got all the depreciations in order. So it means now our calculations and working sheet must be utilized right now. Right now, so number one, I want us to go and calculate depreciation for the new vehicle. That's the first step I want us to do. New vehicle. Let me say we are going to calculate depreciation on new vehicle. All right, new vehicle. And then remember, number one, they are saying we need to check the method. We need to check the method. All right, we need to check the method. And the method says what? We are going to use the straight line method, isn't it? Let's go and double check in our information. So the information says it is the policy of the business to depreciate vehicles at 20% per year according to the straight line method. So now straight line method. So we are going to use the straight line method. So the straight line method says cost price multiplied by the percentage you are given, you multiply by the number of months divided by 12, you will get your depreciation, right? You'll get your depreciation. So now we need to go and calculate our depreciation. So the cost of the new vehicle is given. We calculated it right there, right? So we're just going to say 11,10,700, which is the cost price of the vehicle, multiplied by, remember they said to us, we are using 20%. So 20% out of 100, or 20 out of 100 multiplied by. So obviously we need to determine the period, because now what is the N? We need the N for this. We need the N for this, right? What is the N? What is the period for this? What is the number of months for this? So the N, remember they say, let's go back to our question. I want us to understand this one clearly. The question says, or the transaction says, this new vehicle was purchased on the 1st of August 2005. So it means this vehicle was there from the 1st of August, from the 1st of August 2005 until the end of the year. The end of the year is going to be 28 February 2006. So how many months was this vehicle in the business? So we're going to count. It's going to be August, September, October, November, December, January, February. 7 months. 7 months. 7 months. So we are going to multiply by 7 divided by 12. So how much is your depreciation right there? How much is your depreciation for this asset? How much is the depreciation for this asset? Let's do the calculations quickly. So it's going to be 110,700 multiplied by 20%, which is 20 out of 100, multiplied by 7 out of 12. So I'm getting 12,915. That is the depreciation for the new vehicle. That is the depreciation for the new vehicle. The depreciation for the new vehicle is 12,915 rand, right? And then now I want us to go and calculate the depreciation for the sold, or depreciation for asset disposal, or depreciation for the sold vehicle. Depreciation for the sold vehicle. Depreciation for sold, or asset disposal, or asset disposed. All right. So now remember, this vehicle that was disposed or sold, it was there in the business from when to when. Let's go and check our information. They say to you, it was sold a vehicle which was originally purchased on the 1st of September 2002. So it was there from the 1st of September 2002. I'm gonna get the period for this, or the ends, because the period for this one is a lot. It's not one, because it's going to be, the period is going to be from, the end for this is going to be from the 1st of September 2002 until they sell it. They sold it when? On the 30th of May. Let me just double check that, just to make sure we are in the same and right track. So it was purchased on the 30th, it was sold on the 30th of May 2005. So 30 May, it was there in the business from the 1st of September when it was purchased until 30 May 2005, right? So it means now we have to outline this period accordingly from year to year. So I usually will do this so that it can be understandable. We're gonna have year one. In year one, the vehicle was there from the 1st of September 2002 until 28 Feb 2003, right? And then we're gonna have year two. In year two, the vehicle was there from the 1st of March 2003 until 28 Feb 2004, right? And then year three, remember this one is year one, year two, year three. All right. And then year three, it was there from the 1st of March 2004 until 28 Feb 2000. Remember year one, it was there from 1st September 2002 to 28 February 2003. Year two, it was there from 2003 until 28 February 2004. And then year three, it was there from when? From 1 March 2004 until 28 February 2005, right? And then year four, it was there. This is year four, remember? Year four. It was there from 1 March 2005 until 30 May 2005. I don't know if you guys follow right there. And then that means this vehicle was there for those periods there. All right. And then now we need to calculate all the depreciations from year one, year two, year three, year four, until we finish, right? So now year one, it was there for how many months? It was there from September to February. So let's count there. It's going to be September, October, November, December, January, February. You must count. Even in the test, you count. So it's 6 months. It was there for 6 months. And then year 2, it was there for the whole month, the whole year. I don't know if you get my point, because it's gonna be from March to February, which is 12 months. So it was there for 12 months. This one, there for 12 months. And then even year 3, it was there for 12 months. This is the whole year, the whole 12 months. All right. And then year 4, it was there for March, April, May, 3 months, right? So 3 months here. Okay. And then now we need to calculate depreciation for all of this. Are you with me right there? So we're just going to do this. We're going to calculate depreciation for year 1. Year 1, remember the cost price of the vehicle, of the sold vehicle is 85,000. And then we multiply by 20% out of 100. We multiply by 6 divided by 12, right? It's equal to, and then let's see how much are we getting right there. Let's see how much are we getting. Just put that on the calculator quickly. It's going to be 85,000 multiplied by 20 out of 100 multiplied by 6 out of 12. I'm getting 85,000. I mean 8,500. I mean to say 8,500. Okay. And then we are done with year 1. Let's go to year 2. Year 2, we do the same, 85,000, because remember the formula for straight line says cost price multiplied by the, so we are just following the formula that says cost price, which is 85,000, multiplied by the percentage given, which is 20 out of 100, multiplied by 12 out of 12, because it was there for the whole year, right? And then how much is your depreciation right there? So let's do it. Let's do the calculations. 85,000 multiplied by 20 divided by 100 multiplied by 12 divided by 12. So I'm getting 17,000. I'm getting 17,000. And then because when we go to the next one, which is year 3, we are going to have the same amount as year 2, because it was there for the whole year, or 12 months. So it's going to be 85,000. You multiply by 20 divided by 100 multiply by 12 out of 12. Then you will have 17,000 as year 3. I mean as year 2. Year 3 and year 2 are the same, right? Then let's go to the last year, which is year 4. The year 4, you are still going to follow the formula. The formula says cost price 85,000. You multiply by the percentage given, 20% or 20 out of 100. You multiply by what's this? You multiply by 3, because it was there for 3 months, divided by 12. All right. And then how much is the depreciation right there? How much is the depreciation right there? So you're gonna say 85,000. You multiply by 20. You divide by 100. You multiply by 3 divided by 12. So I'm getting 4,250, right? So that is your depreciation for all the years, right? And then when we are done with calculating depreciation for the sold, I need us to go and calculate depreciation for the remaining vehicle, because after selling the depreciation that cost, I mean the vehicle rather, that costed us 85,000. We bought a new vehicle, right? And then there were vehicles in the business, except for this one of 85,000 that costed 248, right? So it means we call it, some of you call it old, or rather I call it remaining vehicle after selling. Remaining vehicle, right? Remaining vehicle. So now we need to calculate depreciation for the remaining vehicle. So let me say depreciation right there. Depreciation for old or remaining vehicle after selling. So remaining vehicle, we firstly need to calculate the cost of the remaining, cost of remaining first. That's number one. Or cost of the old vehicles or remaining, because remember the formula says you need to say cost price, you multiply by the percentage given, you multiply by the number of months or period divided by 12, you will get your depreciation. So I'm saying we need the cost of the old or remaining vehicle or vehicles, right? So now, excuse me, the cost of old or remaining vehicles is going to be the original cost of vehicles from the beginning, which is 248,000. You remember, you minus, let's see, you minus the cost of the sold, which is going to be 85. It's going to be 85,000. How much is the cost of the new? I mean, of the remaining or old? How much is the cost of the remaining or old? I hope you guys got this. So it's going to be 85,000. No. It's going to be 2,848,000 minus 85,000. And then I am getting 163,000, right? So now, remember, all of these are the amounts that are there. Because remember, they say to you here that you have vehicles that cost 248,000. During the year, you sell one, so you cannot calculate depreciation for this one. We have to exclude the sold, so that we calculate depreciation without the sold vehicle. So now let's go and calculate depreciation for the old or for the remaining. So the remaining vehicle or the old vehicle is 163,000, and then we're gonna say multiply by the percentage given, multiply by the n. So obviously this vehicle was there for the whole year. The remaining ones are there until the end of the period. So you always know it's gonna be 12 divided by 12, right? So how much are you getting right there? Let's get the depreciation for the old or for the remaining quickly. So it's gonna be 163,000 multiplied by 20 divided by 100 multiplied by 12 divided by 12. Some of you can say 12 divided by 12 is not necessary, but anyway, let's just proceed like that. So I'm getting 32,600. All right. And now when we are done there, we are going to prepare the accumulated depreciation and the depreciation account together with the asset disposal. So let's go and prepare our accumulated depreciation account, right? So in the accumulated depreciation account, we are going to need depreciation for the current year. Depreciation for the current year. Depreciation for the current year. Depreciation for the current year for all vehicles. All right. So let's start with the depreciation for the new. Depreciation for the new. Let's start with the depreciation, not for the new. Let's actually start with the depreciation for, remember folio there, general. Let's start with the depreciation for the sold. Depreciation for the sold in the current year. Depreciation for asset disposal in the current year. Our current year is 1 March 2005 until 28 February 2006. But this vehicle for the current year was only there for 3 months. So our current year depreciation for the sold is 4,250, right? So let's go and record that in our answer sheet. 4,250. That is the depreciation for the sold, right? And then we are also going to need depreciation for depreciation. We're going to need depreciation for the old and the sold and the new. So depreciation for the new and the sold are depreciations that are going to be at the end of the year, because this one was there for 30 May, was until 30 May. And then here we're going to need depreciation for 28 Feb at the end of the year. What is the depreciation that we are remaining with at the end of the year? Right? So it's going to be 2 depreciations here. At the end of the year, we are closing with 2 depreciations, which is depreciation for the old of 32,600 plus depreciation for the new, which is 12,915. Those are depreciations that are in the same date. Or you can still like outline them. Depreciation for the new. You also outline depreciation for the old and for the new, no problem. Depreciation for the sold, depreciation for the old, and depreciation for the new. You can outline them in 3 forms, no problem, right? But I would prefer that you do them this way because it's the depreciation for the same date. Then we can add them and get the total right there. So let's get the total. So it's going to be depreciation for the old 32,600 plus 12,915. I am getting 4,515. That's what I am getting for the depreciation at the end of the year, which is depreciation for the old or remaining plus depreciation for the new. I hope you got me. And then when we are done, we go to the debit side of the accumulated depreciation. We're going to have to calculate depreciation, accumulated depreciation for the asset disposal. Accumulated depreciation for the asset disposal. Accumulated depreciation for the asset disposal. So accumulated depreciation for the asset disposal, right, is going to be total depreciations for all, total depreciation for the vehicle sold from the day we purchased it until now, until the current year. So that means you're going to add depreciation for year 1, the accumulated depreciation. So it's going to be, that must go to asset disposal, is all depreciations. So it means you have to add depreciation for year 1, which is 8,500, plus depreciation for year 2, 17,000, plus depreciation for year 3, which is 17,000 as well, plus depreciation at the end of the year, which is 4,250. This depreciation, as you get it here, you are going to record it on the debit side of the accumulated depreciation as asset disposal. So let's see how much are we getting right there. So it's going to be 8,500, I mean to say, plus 17,000, plus another 17,000, plus 4,250. So I am getting, let's see, I am getting 46,750. 46,750. So this 46,750 is the the total accumulated depreciation for the sold vehicle or for the asset disposal. So it comes there, right? It comes there. And then remember folio, I can put folio, general, even there, folio, general, okay? And then here, it's gonna be 4,6,750. That is your accumulated depreciation for the asset disposed, of which it was calculated from all the depreciations of the sold vehicle from the day we purchased it until we sell, right? Depreciation for year 1 until year 4. We add all of them. They are going to be recorded in the accumulated depreciation account on the debit side as asset disposal, right? And this was until 30 May, because that's when they sold the vehicle. Is it 30 May or 31? 30 May. So that's 30 May. All right. No problem. And then we are done with this. Now we need to close the account because there's no more any other depreciation. So to close the account, we're going to have balance carried down. Balance carried down of how much? So the bigger side obviously here is the credit side. So we have to add everything in the credit side and close with. So 80167 plus 4250 plus 45515. All right, and I'm getting a total of 129,932, right? And then even on the other side, I will close or total with 129,932. That is your total, right? And then we are going to say the total of 129,932 less asset disposal accumulated depreciation of 4,675, right? I am getting 176. Let's see. We have to say 129,932. All right, minus 46750. 46750. And then I am getting 83,182. 83,182. That is your closing balance. And remember, closing balance will be opening on the 1st of March the following year. So we're gonna bring it one day, March, and then we're gonna say balance brought down of 83,182, and then we are done. All right, we are done. Let me just highlight these ones so that we always know what we are doing. Even this one here, I'm gonna highlight with the same mark so that we know. And then even this side, we have this one. And then we put this one. Remember, you always need to indicate this because when they say balance properly, it must also indicate the opening balances of the following year, which is the closing of the current year, right? And then let's proceed. We are done with accumulated depreciation account. And then we go to depreciation. When you go to depreciation, you are just going to apply double entry system or duality principle, where you are just going to say, depreciation on the 30th of May. Let's see, let me do this. All right, and then depreciation on the 30th of May is going to be, you are going to call it accumulated depreciation here. You are just doing the double entry system method, or you are applying the duality principle. Accumulated depreciation. Right? And then that will go to your folio, is going to be general journal. And then you're just gonna copy this one of 250,250. You see, now you're just taking from the credit side of the accumulated depreciation to the debit side of the depreciation, which is applying the double entry system. Because once you get everything right in the accumulated depreciation account, you will definitely get things right in the depreciation. And then we also have another accumulated depreciation, which is depreciation at the end of the year, 28 Feb, which is going to be accumulated depreciation. Depreciation. And then we're gonna go there and say general journal. You're just going to take this one here and bring it there. Duality principle, remember. So it's going to be 45515, and then you are done. Then you have to close this account. So you add the 2. Let's add the 2. It's gonna be 4250 plus 4514515, right? Of which is gonna give you 49765, right? And then even this side is gonna be 49765, and then you're gonna close this account with profit or loss. Profit or loss of how much? Of 49765. Then we are done with the depreciation account. This is the format. This is the right way of doing or preparing the accumulated depreciation account. Let's go to the asset disposal. Let's go to the asset disposal. So the asset disposal, right? The asset disposal, remember we made a disposal on the 30th of May. So we go to the credit side, debit side, and say 30 May. Let me just reduce this font. Okay, 30 May, that's when we disposed the vehicle. And then we're gonna say details, we disposed a vehicle. How much was the cost of the vehicle? The cost of the vehicle, we're going to fetch it from vehicle account up there on the credit side. Also, we are applying we are applying the duality principle. We're going to take this 85,000. We bring it to the credit, to the debit side. From the credit side of the vehicle account to the credit side, debit side of the asset disposal, which is 85,000. All right. And then folio, general journal. All right. And then on the other side, we are going to have accumulated depreciation. Accumulated depreciation. Accumulated depreciation. So on the other side, accumulated depreciation is going to be this one. We are going to take the one in the accumulated depreciation of 46750, this one where you said asset disposal. You're going to take this one, you apply double entry system, general journal there on the folio, and then it's going to be 46750. All right, and then the date will be at the end of May, or you can just say 30 May or 31st May. And then because we utilize 30 May, let's use 30 May even everywhere. All right, where there is a May transactions, let's just use 30 May. All right, no problem. So now we are done with that, with the copy and paste. And then let's go back to the question. Remember, the question says you sold a vehicle which was originally purchased on the 1st of September 2002 for 85,000 on credit to ME for 68,000. So you sold on credit. When you sell on credit, you're gonna go to your asset disposal account on the credit side and say debtors, because if you sell on credit now, debtors is affected. Debtors, and say debtors control, no problem, or you can just say debtors. And then you're gonna say GJ right there. And then this side, you're gonna have 68,000 that you sold with, 68,000, right? And then when you are done, you are going to outline whether you've got a profit or a loss. So listen to me. Now we're gonna check, do we have, which side is bigger? Number one, because we need to determine whether we've got a profit or a loss on sales of an asset, right? So when we check, we've got a bigger side on the credit side. We've got a bigger side on the credit side. So that means we're going to start balancing from that side, or getting the total from that side, which is going to be 46,750 plus 68,000. And then I am getting 114,750. All right, even this side we're gonna have 114,750. All right, and then that means the smaller side we balance with it. So listen, if the credit side is bigger than the debit side, we will have profit on the credit, on the debit side, profit on sales, right? If the credit side is bigger than the debit side, we will balance with the profit on sales on the debit side, right? Meaning, if we have the debit side bigger than the credit side, we will close with a loss on the credit side. I don't know if I make sense. So, of which I'm going to say 11. Now I have to calculate my profit there, 114,750 less 85,000. I will get my profit of 29,750. I don't know if that makes sense right there. So that is your profit, okay? That is your profit. So remember, I say to you, if the debit side is bigger than the credit side, you've got to close with a loss on the credit side. And if the credit side is bigger than the debit side, you're going to close on the debit side with a profit on sales. Remember, we cannot have both profit and a loss. Either we have got a profit or a loss. So that is your question for asset disposal. I hope you will learn something new. I hope you're going to grab something new. And I believe that you're going to make it. You will never fail asset disposal question again. And thank you for watching. Please do not forget to subscribe, like, and share. And remember that we are also offering private sessions or private tutorials, whether face-to-face or online. And if you need any of those, you can also put a comment here on my YouTube channel, and then I'll attend it to you. Thank you and salute.